Robschild. No investment advice. I have not been making videos over the past week for two reasons. One, the Santa Claus rally is a good time to pretty much just cover your eyes and not look at the markets, although I can't really help myself, so I decided to do a weekly update. Also, I've been traveling for the holidays. I will get back to the regular daily shows most likely on Monday, if not probably Tuesday. Today is Saturday, December 28th, 2024. Today's episode starts with mentioning that the Santa Claus rally is not looking good. If you've been following the show, you'll know that I did mention, granted it's not over yet, the timeline of the Santa Claus rally, but it's showing enough weakness that, we should be paying attention at the very least. But I had mentioned before the Santa Claus rally began to be careful with this one because of all of the daily reminder macro views that I have. Again, go back to the tornado, the most recent macro show with the tornado and the ball to see my walkthrough on that. Also, if you're subscribed to the channel, you may have come across my post in the community tab talking about the Santa Claus rally being in effect, and I did mention on Thursday if I was trading it, I'd take the nice little gain and run. That was when it topped out, and now today, as you can see, we've lost a good amount. Most of this Santa Claus rally, if there is one. The average gain, by the way, of a Santa Claus rally is only 1.3%. So if you get that, if you're playing it and you get 1%, take it and run. Don't sit in it. Would be the strategy that I would do if I was trading it. Like I said, I wasn't trading and I'm not in it. In a healthy Santa Claus rally, you don't really want to see a spike in the VIX like we saw on Friday. Next thing on the agenda, I added two items to the daily reminders. These are not new developments, nor are they things that I haven't mentioned before, but I think they should be on here. They should be on this list. I just wanted to add the home to price income ratio is still sitting at record highs, and that the leading indicators they're collapsing right now. They have been for a while. Let me pull those two charts up. Longtermtrends.net has a nice little chart here showing the median home price to income ratio, and as you can see, again, this isn't a chart I haven't brought up before, but we're at record highs right now, at it taking about 7.2 years to be able to afford a house. Sometimes this gets as low as 5, or previously as low as, what is this number here? Sorry, don't have my regular monitors. It looks like it's below 4. Yeah, like 3.6 years to buy a house. So record high as far as the cost of houses go. If you feel like homes are expensive, well, they are, simply put. And then the other chart is this United States leading index. This is on tradingeconomics.com. A nice chart showing, every single time this curls to the downside, these are like recessions. Every time it goes down, it's, this is the dot-com bust. This is the financial crisis. This is the COVID dip. And right now, from March of 2022, this has been just going straight down. This is not going up. This is going straight down. It's just one of these things that I haven't included in my daily reminder macro Mondays. I haven't talked about them for a while, so I figured I'd add them to the list and make sure to include them in the future macro shows. Next item on the agenda, from this previous week, we hardly had any economic data coming out, but we did have initial jobless claims coming in low. I think it was 219,000 initial jobless claims. That one's low, although, the continuing claims is still going higher and higher, which is, saying that things are getting worse indeed. We're kind of waiting to see the initial jobless claims spiking at this point in the cycle, and it hasn't done that yet, although I suspect that's coming in the very near future. Next on the agenda, the Fed funds futures is still showing only one cut for all of 2025 and no sign of re-inversion. I have been mentioning in the show how we could end up in one of these scenarios where we reverted, the yield curve uninverted or reverted, and then inverts again and stays inverted even longer. And that can actually be more bullish for stocks, and we haven't seen that yet. We're sitting in a reverted state. No sign of going towards inversion again yet, anyway. And then last item on the agenda, no portfolio updates, but I have been buying more TMF with my income, from dividends and other income. This is where I'm buying to maintain my 57% exposure to long duration treasury bonds. I wanted to add this in case anyone was curious if I was running away from the long bond exposure. No, the cheaper these get, the more attractive they become to me in my book. And part of the reason for this is that, it's actually expected for the 10-year note yield to go up sometimes during recessions, and I'm going to put in stars here, the key word is temporarily. So looking through the history of the 10-year note yield, this is on the Fed website. This current chart goes back to 1965. You can see during the Great Financial Crisis, if I zoom in on this, if it lets me, during the recession, when we hadn't called it, even when we hadn't even called it a recession yet, we had, the 10-year note yield go from 3.34 all the way up to 4.27. That's almost an entire point up before, rolling over to absolutely collapsing during the recession, which you typically almost every time you get this collapse in yields. Once in a while, it doesn't happen, but it almost always happens. Just to go over the other examples, the dot-com bust. Remember, the gray area is the recession. So during the dot-com bust, we went from 4.73 going all the way up to 5.51. Again, that's a full percentage added of yield before collapsing during the recession. Then going back even further, let's go to the 1990 recession. We went from 8.36 all the way up to 9% before again collapsing in yields during the recession. Anybody seeing a pattern yet? Recession of 81, 14 all the way up to that final peak of yields of 15.76%. That would have been a marvelous time to load into treasuries if you had the foresight to do so before collapsing and further collapsing through this depression, losing 5%, in nominal percentage terms throughout that recession. And then let's see here, the 1981, the one right before that. This was, during peak inflation times where it was getting out of control. Obviously, a 13% yield on treasuries is extraordinary. There's no other way to put it. But even during this one, we rose up a lot during the recession before going to new lows during that recession. And then going back to the 70s, this is the one where we didn't see a lower low in the 10-note yield. And this was during, inflation that just kept going, and it caught everybody by surprise, and so yields were not allowed to go lower at the end of this recession. In fact, we went to higher highs. Now, let's see, before we discuss that further, I just want to show the last one on this chart in from the 1969 to 1970 recession. You can see there were periods where we went up, obviously, from 7 all the way up to 8, before, collapsing, and then collapsing even further coming out of the recession. Now, people, including myself, understand that. So there's that one recession where yields went higher and then had a higher low and continued higher, and that, by most people's view on this, including my own, this had more to do with the baby boomer generation than anything else. It was a large expansion of people existing, all wanting the same things, all wanting houses and all the same stuff. Just, it was a demand-driven inflationary cycle. We're currently not in that. We're having declining birthing rates. We have an aging population, and so if anything, and also, by the way, leading into Republican-controlled President, Senate, and House, the borders clamping down, there's going to be less people, and we're currently in an aging environment, not a booming baby boomer generation kind of thing. Some people refer to the past few years inflation cycle being driven largely by fiscal debt. That there's yes and no. It has a lot to do with supply chain disruptions as well. Either way that you see it, one of Lynn Alden's views is that this inflationary cycle is more like the 1940s. And you know what? Let's take a look at what happened to interest rates in the 1940s. Yeah, there was the World War II, and we had very high fiscal deficit and inflation, but the yields were not spiking. Taking a chart from researchgate.net, this shows where the yields were. We had the 10-year T-bond, they call it. We call them notes now. I don't know if they were called bonds then. But we, from the 30s went from 3.5% down to a low of 2%, back up to 2.5% during the mid-40s, and sort of went sideways more than anything. And also the we have the 3-month Treasury bills, those went up, but the longer rates stayed pretty flat, basically. And as you can see at the end of the end of this little gray bar period, I think this marks where we had price controls or something like that. Anyway, we did have high inflation here, but rates they didn't go super high. They were basically flat, if anything. Certainly nothing like we saw in the 1970s, which is, it's funny that I feel like I'll call them the inflationists, people that think that we're in this new, they call it the long-term debt cycle. I think Heresy Financial keeps bringing up. I don't believe that for one second. I think the 1970s was a one-off event that we're not. We might see that again at some time in the future, and that's not what's happening right now. I don't think we're having inflation lead to more inflation is the biggest point of all of this. If I did, I wouldn't be holding long-duration treasury bonds. And can I be wrong? I guess I can be. I think that my logic is sound, and I think I'm making good decisions based on my macro views. But I can certainly be wrong. One key part of investing in general that's very important is to realize the fact that things can happen out of your control, and you can be wrong for any reason under the sun. At the end of the day, the world, especially the financial world, is controlled at the end of the day by people making all sorts of crazy decisions with, involving wars, prices, and investment decisions affect the way people live their lives. I'm currently reading a book called The Psychology of Money by Morgan Housel. It's very interesting. I'm going to do a book review on it. But one of the key points that I'm getting out of it right now that's helping me, and it's just a good reminder that I've already had in the back of my head, is to realize that you can be wrong, especially when you're, assuming certain things are going to play out the way that you expect them to, because they don't. Because anything can happen at any point. Any investing strategy can fail miserably, and the more risk that you take, the more the more spectacularly that can fail. And so that's why it's very important to mitigate your risk and realize, what can I lose, and am I okay with that? If you put your entire life savings into options contracts, like let's say, you're sure the market's going to roll over and go down, and I believe it will. I think it's very probable. But what if your decision based on that idea is to put every penny that you have into long-dated SPY puts or something? And I don't know, the election spurs on people's brains that they just need to keep loading into the stock market, and we have some kind of Japanese blow off top like we had previously in the stock market. Anything can happen. Even if you're completely right, you can be wrong, because people are emotional. They're dumb. They're dumb, and they do crazy. People are crazy. And that's one huge takeaway, important takeaway from that book. Again, I'll do a full review of it once I'm finished. Anyway, no updates, and before we get into more charts, there's no updates on the daily reminders. Again, watch the show titled Robschild Friday the 13th. It was my Monday. That was my most previous macro Monday show. It has a tornado in the crystal ball. None of these have changed. Again, I just wanted to add these because I think they are very important things to have in mind regarding where we are in the macro environment. Also, as I said earlier, no changes in my portfolio. I've been, the value of my long duration has been going down, and I've been adding to it with my income, and I'm currently sitting on 57.4% actually in long duration T bonds, and I'm adding leverage right now because I believe I'm right, and I want to benefit from my views. So the crystal ball readings and portfolio, nothing's really changed. Alright, onto the charts. So we'll start. We already saw the S&P 500. Like I said, if I had been trying to trade the Santa Claus rally, I would have gotten out on Thursday successfully, and went down on Friday. This is not. There are many people out there noting the breadth of the market is getting extremely weak. On first glance at the S&P 500, this doesn't look so terrible, but taking a look at, let's take a look at this one first, the fear and greed index of CNN. We are solidly in fear. The chart doesn't look very fearful there, but when you take a lot of other indicators into account, we are actually in fear mode right now. And when we're in fear mode, it's pretty expected for markets to continue to go down until we get at least back to neutral or greedy again. Additionally, I bring this up sometimes. pyinvesting.com has a fear and greed index of their own that has not been this high in cash for quite a while now. Recently, over the past week, we actually got up to 40% in cash and 60% in the S&P 500. Again, this strategy is supposed to help you with periods of drawdowns to benefit from not going through those drawdowns. And obviously, the black line here is how this fund has performed, and it's underperformed since 2014. But, starting in 2006, it outperformed for quite a while, all the way through 2012, it looks like. And so, especially in times now where it's expected by me and, I don't know, pretty much everyone else under the sun to have some volatile times here, I would think this strategy would benefit people at this point, but I'm just a guy with a crystal ball. Anyway, moving on through things that I noticed in charts. Wanted to start with the dollar. This is clearly forming a bull flag here, looking like it is prepping to break out to the upside. I'm not sure if it will or not, but it certainly looks like it wants to do that. TLT, I was wondering when it would stop just going down, and it stopped just going down. Will it go down further? It can. If you look at I'm not going to pull up the chart, but the 20-year Treasury Treasury bond yield is at the same level. It's at a trend line top, basically. It's at like 4.8%, and so there's buyers here, basically, including myself. Actually, this might be a bottom. This might be the bottom of the cycle for long duration Treasury bonds. I'm not entirely sure. I'm happy to be in this while stocks are so overvalued. Again, nothing's really changed from my macro views, and if anything's changed, it's simply that bond yields have gotten even more attractive compared to the valuations of stocks than they were, back in just not too long ago, right? We had that spike up, and I mean, even throughout this whole month, it's kind of funny, but the lower they go, the more attractive they become. That's how bonds work. But anyway, moving on, I wanted to bring up XHB for two reasons. One is that while stocks have been sitting near or at all-time highs, home builders often acts as a pretty strong leading indicator and has been showing a lot of weakness, and now forming a very clear, formidable bear flag here. This is, again, I always use daily charts. Each bar is 1 day candle, just absolutely tanking from November through December, and now forming a flag. And it won't be surprising to me if this continues lower. It certainly looks like it wants to go that way. Next, we have Dr. Copper with a PhD in economics. I bring up this chart because this is a head and shoulders top here, going back to October of 2023, a very large one, I might add. We broke the neckline very recently, and we've been bumping our heads up on this line, suggesting to me that this line is valid, and I would expect with fairly high probability for copper price to drop pretty significantly based on this chart pattern here. Next two charts, we'll start with Bitcoin. That's a little more popular, I guess. Still within this, I'm calling this I wrote about this in my community updates too. If you're subscribed, you may have seen it. We are in a ascending, broadening wedge at the top of a pattern. This is 75% of the time a reversal signal, and it has all the characteristics. We hit 1, 2, 3 times on the top, 1, 2, 3 times on the bottom. So I am expecting Bitcoin to roll over here to the downside along with most of the rest of the market. Last chart on the agenda, or not on the agenda, but ones that I wanted to share, was just MSOS. The cannabis ETF just astoundingly low at $3.50. I don't think I said that I didn't think there could be possibly be more fear in this market back, when we found out the election results, and the Republicans are taking over, so that's probably not good for the cannabis industry, is sort of the mindset of the price of this fund here, whether it's true or not. And $3.50, if this recovers, I mean, the percentage returns, the potential percentage return rewards on this are just absolutely enormous. I mean, imagine if we don't get the kind of crackdown that's expected on this industry and these stocks, even if they recover a little bit. Just to remind everybody, the price of this entire ETF, this entire fund, was $56 only 3 years ago. Now at $3.50. Unbelievable. There has to be, I still hold like 1% of my portfolio in this fund. I think I bought most of it in around $4 when it first dropped. If the companies in this industry have any value at all, I mean, it seems like it might be a decent opportunity, but I don't know. I'm astounded at how cheap it's gotten. At this price, this is for all practical purposes zero. This is people. Everyone that's selling their shares are selling at enormous losses, and usually when that's happening, the people benefiting are the ones that are buying for an entire industry. I mean, can the whole thing collapse? Can every single cannabis